There is a lie at the heart of the financial world, a lie so pervasive and so constantly repeated that we have mistaken its roar for truth. It is broadcast every second of every day, from the glowing ticker tapes that snake across television screens to the refresh button on the stock app in the palm of your hand. The lie is that the price of something, the number that flashes in red and green, is the most important piece of information. The lie is that this flickering digit represents reality. Warren Buffett, the man who built an empire of hundreds of billions of dollars from the ashes of a failed textile mill, built that empire on a single, foundational truth that serves as a direct antidote to this lie. The truth is this: price is what you pay, value is what you get. These two things are almost never the same, and the chasm between them is not a source of confusion, but the single greatest source of fortune available in a free society. The market price of an asset is a temporary, emotionally driven distraction, a number dictated by the whims of a frantic crowd. The true intrinsic value of an asset, however, is a hard, knowable number based on the cold, hard cash it will generate for its owner between now and Judgment Day. Understanding how to ignore the former and calculate the latter is the master skill of wealth. It is the dividing line between gambling and investing, between speculation and ownership. What you are about to embark on is not a lesson in stock tips. It is a fundamental rewiring of the way you see money, business, and the very nature of an asset. We are going to deconstruct the operating system of the world's greatest capital allocator, focusing on this one central principle. This is the key that unlocks everything else. Because once you learn to see the difference between the price and the value, you will never look at the world the same way again. Our journey begins not with a formula, but with a character. A business partner so unreliable, so prone to wild mood swings, that any sane person would refuse to deal with him. And yet, millions of people, every single day, hang on his every word, letting his emotional state dictate their financial future. This partner was the creation of Benjamin Graham, the father of value investing and Warren Buffett's intellectual mentor. Graham gave him a name, Mr. Market, and the story that best illustrates the sheer dangerous insanity of Mr. Market and Buffett's genius in exploiting it is not found in a textbook, but in a scandal that involved vats of rancid salad oil. The year was 1963. The world was a place of burgeoning confidence. The American economy was humming. And one of the most trusted blue-chip names in American business was American Express. It was the epitome of financial stability. Their traveler's checks were as good as gold, a global currency for a world on the move. Their credit card was a status symbol, a passport to the good life. The company was a fortress. Then, the fortress was rocked by a scandal so bizarre it sounds like fiction. A man named Anthony Tino DeAngelis ran a company called the Allied Crude Vegetable Oil Refining Corporation. His business was simple. He bought and sold vegetable oil, a massive global commodity. To get loans for his business, he used his inventory of oil as collateral. He stored this oil in massive tanks in Bayonne, New Jersey. American Express, through a subsidiary, ran a field warehousing division. Their job was to verify the inventory in those tanks and issue warehouse receipts that DeAngelis could then take to a bank to get a loan. The receipt from American Express was a stamp of certainty. It meant the oil was there. But Tino DeAngelis was a con man, a brilliant one. He discovered that if he filled the massive tanks mostly with water, a thin layer of salad oil on top would fool the inspectors. He created phantom tanks, interconnected pipes that could move the same oil around to be counted multiple times. He forged receipts. He ran a massive, dizzying fraud. For years he borrowed more and more money against oil that simply did not exist. In November of 1963, the music stopped. The great salad oil swindle collapsed. DeAngelis's company went bankrupt, defaulting on an estimated $175 million in loans an astronomical sum at the time. The banks that held the worthless warehouse receipts turned to the one entity they believed had the deep pockets to make them whole: American Express. Wall Street panicked. This wasn't just a bad loan, it was a potential death blow. The headlines were brutal. The fear was that American Express's liability for the fraud would be so immense it would wipe out the company entirely. Mr. Market, that manic depressive business partner, read the headlines and had a complete nervous breakdown. He went from loving American Express, the blue-chip stalwart, to utterly despising it overnight. He screamed that the company was worthless, a fraud, a bankrupt shell, and he began offering to sell shares at any price to get rid of them. The stock, which had been trading at over $60 a share, collapsed. It was cut in half, plummeting to $35. The financial world, the entire herd, was running for the exit. Sell now, ask questions later. The price was falling, and in the mind of the 99%, a falling price means a bad business. But a 33-year-old Warren Buffett, running a small investment partnership out of Omaha, Nebraska, saw not a crisis but an opportunity of a lifetime. He did not look at the stock ticker. He did not read the hysterical headlines and react. He understood that Mr. Market was a neurotic, and his frantic wadok were offers to be analyzed, not instructions to be followed. So Buffett did what the speculators never do. He did the work. He set out to determine the true intrinsic value of American Express, completely divorced from its collapsing stock price. He didn't build a complex financial model in his office. He went out into the real world. He engaged in what his partner Charlie Munger would later call scuttlebutt. He went to banks. He went to merchants. He walked into restaurants and hotel lobbies. He stood in line at travel agencies. And he asked simple questions. He asked bankers if the scandal had caused them to lose faith in American Express travelers' checks. They all said no. The checks were still the gold standard. He asked hotel clerks and restaurant owners if they were seeing fewer people use the American Express card. They said no. Business was booming. The customers didn't care about a warehousing subsidiary in New Jersey. They cared about the convenience and prestige of the card in their wallet. Buffett realized something profound. The source of the panic, the salad oil scandal, had absolutely nothing to do with the two core, magnificent businesses of American Express. The traveler's check and the credit card businesses were its mighty engines of value. They were, in effect, a float business. People gave American Express their money for traveler's checks, and Amex could hold that money, earning interest on it, for weeks or months before the checks were cashed. It was a brilliant economic model. The scandal was a flesh wound, but the market was pricing the company for decapitation. After his investigation, Buffett calculated the maximum possible loss from the salad oil liabilities. Then he calculated the enormous, ongoing earning power of the core businesses. He concluded that the intrinsic value of a single share of American Express was, at a minimum, around $60. Mr. Market, in his fit of depression, was offering to sell him that $60 bill for just $35. It was the bargain of a decade. Buffett acted decisively. He invested 40% of his entire partnership's capital, $12 million, into American Express stock. It was the single largest investment he had ever made. Over the next few years, as the company settled the legal claims for pennies on the dollar and the powerhouse card and check businesses continued to churn out cash, the market's mood inevitably swung back. The panic subsided. Sanity returned. The stock price soared, eventually tripling, handing Buffett's partnership a massive $20 million profit. He had faced down Mr. Market at his most hysterical, and, by focusing on value instead of price, had won. This story is a masterclass in the underlying psychological principles that Buffett either consciously or intuitively exploits. The rest of the market fell prey to two of the most powerful cognitive biases that plague human decision-making: herd mentality and the availability heuristic. Herd mentality, or social proof, is our deep-seated instinct to follow the crowd. Our brains evolved on the savannah, where seeing everyone else run was a very good signal that a lion was nearby and you should run too, without stopping to ask why. This instinct, so vital for survival, is utterly catastrophic in the world of financial markets. When the price of American Express started to fall, investors didn't see a business, they saw a stampede. Their primal brains screamed, "Everyone is selling, I must sell too." They outsourced their thinking to the collective, and the collective was in a state of blind panic. Buffett's superpower was his ability to detach, to stand apart from the herd and think for himself. Compounding this was the availability heuristic, a mental shortcut where we overestimate the likelihood of events that are more easily recalled in memory. The salad oil scandal was dramatic, shocking, and vivid. It made for terrifying headlines. American Express faces bankruptcy is a much more memorable and emotionally charged thought than a sober analysis of the company's long-term earning power from its travelers' check float. The dramatic, available information of the scandal crowded out all other, more important data points in the minds of most investors. They anchored their entire valuation of the company on the most recent, most frightening piece of news. Buffett, by contrast, deliberately ignored the vivid narrative and focused on the boring, durable reality of the underlying business. He understood that the story of the day is almost always a distraction from the economic engine of the decade. So how can we, who are not the Oracle of Omaha, apply this? We can translate this into a practical mental model, a blueprint for action when the next crisis hits a company you are interested in. Let's call it the journalistic inquiry model, because it requires you to act like an investigative reporter, not a panicked spectator. Step 1. Isolate the news story. When a stock plummets, take the specific headline and treat it like a hypothesis to be tested. Company X loses major lawsuit. Company Y faces new competitor. Write it down. Be specific. Do not get caught up in the emotional language surrounding it. Step 2. Quantify the maximum potential damage. This is crucial. Do the math. What is the absolute worst-case financially quantifiable impact of this news? For American Express, Buffett calculated the total value of the loans, which was the ceiling for the company's liability. Often you will find that the market's reaction in terms of market capitalization lost is 5 or 10 times the worst-case financial impact. Step 3. Analyze the core business, the economic engine. Ask the question Buffett asked, is the long-term primary earning power of the company affected by this news? Does this lawsuit change the fact that millions of people love their product? Does this new competitor invalidate the company's powerful brand or distribution network? You must separate the temporary problem from the permanent value. Step 4. Talk to the ecosystem. This is the scuttlebutt method. You may not be able to call up bankers like Buffett, but you can do your own version. If it's a retail company, go to the stores. Are they busy? Talk to employees. Are they motivated? Go on forums where customers talk about the products. Is the brand loyalty still there? Become a real-world analyst. Gather data points that Mr. Market in his ivory tower is completely ignoring. Step 5. Make a decision based on the business, not the ticker. Once you have done this work, the flashing red numbers on the screen become irrelevant. You have a rational, evidence-based opinion on the company's value. The market price is now just an offer. Is it a good offer or a bad one? You decide, based on your work, not on the fear of the crowd. Now, let's contrast this with the path of the 99%, the antithesis of the Buffett approach. This is the path of ticker tape hypnosis. The average person wakes up, and the first thing they do is check the stock prices on their phone. They have the financial news channel on in the background all day, a constant IV drip of noise and opinion. Their emotional state rises and falls with the green and red arrows. They are completely mesmerized by the price action. They see a stock that has gone up 100% in 6 months, and they are consumed by the fear of missing out, FOMO. They don't know what the company does, they haven't read the annual report, they have no idea what its intrinsic value is, but they know the price is going up, so they buy, often at the peak of the mania. Then, an earnings report disappoints, or a negative headline hits. The same stock falls 30%. The ticker tape hypnotist is now consumed by panic. The herd is selling. The talking heads on TV are grim. So they sell, locking in a loss. They were a slave to Mr. Market on the way up, and they are a slave to him on the way down. They confuse the ticker with the business. They think a rising stock price means a good company, and a falling stock price means a bad company. This is the exact reverse of the truth. A rising stock price makes a company a more expensive and therefore less attractive investment. A falling stock price, assuming the underlying value is intact, makes it a cheaper, more attractive one. The 99% are programmed to buy high and sell low, a direct path to the destruction of capital. The direct financial connection here is the creation of a portfolio that is either full of value traps or bubble assets. When you divorce price from value, your actions have a direct and massive impact on your net worth. The price Buffett paid for American Express, roughly $35 a share, anchored his entire investment. His return wasn't based on what happened the next day or the next week. It was based on the massive gap between that $35 price and the $60 plus value. That gap is the source of all profit in value investing. It is the tangible manifestation of doing your homework. When the price eventually rose to reflect the value, his financial gain was locked in. For the ticker tape hypnotist, their financial reality is the opposite. By buying a hot stock at a price far above its intrinsic value, they are not buying an asset. They are buying a liability. They are purchasing a future loss. Their balance sheet may show a gain for a while as the bubble inflates, but it is an illusion. The value is not there to support the price, and when sentiment shifts, the price will inevitably collapse to meet the value, wiping them out. This single distinction, seeing price as an opportunity and not a report card, is the foundation of all serious wealth management and professional asset management. It is the difference between building a fortress of financial freedom and building a sandcastle of speculative hope, waiting for the tide of reality to wash it all away. If the first pillar of Buffett's philosophy is understanding the manic depressive nature of Mr. Market, the second is forging the weapon you will use to defeat him, a rational, independent calculation of intrinsic value. This is the bedrock of certainty in a world of chaos. It is the act of looking at a business not as a flickering symbol on a screen, but as a machine for producing cash, and then determining what that machine is worth. For Buffett, the concept of intrinsic value isn't an abstract academic theory. It's a number he is trying to get as close to as possible. He defines it simply as the discounted value of the cash that can be taken out of a business during its remaining life. And the story that marks his own evolution in understanding this concept, the pivot from buying merely cheap companies to buying truly wonderful ones, revolves around a box of chocolates. The year was 1972. Buffett and his partner Charlie Munger were presented with an opportunity to buy a company called See's Candies. At this point in his career, Buffett was still very much a disciple of Ben Graham's cigar butt investing. The idea was to find a company that was so cheap it was like finding a discarded cigar on the ground with one good puff left in it. You could pick it up, get that one free puff of profit, and then throw it away. These were often terrible businesses trading for less than the value of their assets. They were statistically cheap. See's Candies was different. It was not statistically cheap. It was a wonderful business, and its owners knew it. The company, founded by Mary C. in 1921, had built an almost cult-like following in California. Their chocolates were a beloved local institution, a default gift for holidays and special occasions. They had a powerful brand, and with that brand came a magical economic characteristic: pricing power. Every year they could raise the price of their chocolates a little bit, and their loyal customers would happily pay it. They didn't need to spend massive amounts on research and development. They didn't have to constantly retool their factories. They just sold delicious, high-quality chocolates from clean, inviting stores, and cash poured in. The owners were asking for $30 million. Buffett, looking at the company's book value, its tangible assets like factories and inventory, saw that it was only worth about $8 million. The cigar butt investor in him recoiled. Paying a premium of over $22 million for goodwill or brand value seemed extravagant. His initial calculations, based on the company's earnings at the time, suggested a price closer to $20 million. The deal almost died. Buffett was ready to walk away. It was Charlie Munger who pushed him. Munger argued that they were thinking about value incorrectly. They were too focused on the assets in place, the book value. The real value of See's Candies wasn't in its factories, it was in the minds of its customers. The brand, the loyalty, the ability to raise prices year after year without losing business. These were enormous, intangible assets that the balance sheet didn't capture. They were buying a perpetual cash-generating machine, and it was worth paying up for quality. Buffett was convinced. They re-examined the numbers, focusing not on the reported net income, but on what Buffett would later call owner earnings. This is the real cash flow of the business. It's the net income, plus non-cash charges like depreciation, minus the average amount of capital expenditures the business needs to spend each year to maintain its competitive position. It's the answer to the simple question: if I owned this whole business, how much cash could I put in my pocket at the end of the year? They looked at this owner earnings figure and projected it into the future. They realized that because of its pricing power and brand loyalty, See's could grow its earnings steadily, with very little need for new capital investment. It was a gusher of cash. They ultimately negotiated the price down to $25 million. It was still far more than book value, but they knew it was far less than its intrinsic value. The purchase of See's Candies was a watershed moment. It has since generated over $2 billion in cash for Berkshire Hathaway, cash that Buffett was able to redeploy into other investments. It taught him that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And it all came from shifting his focus from what a company owned to what a company could earn. This mental shift is a direct assault on two common cognitive errors: the focusing illusion and anchoring bias. The focusing illusion is our tendency to place too much importance on one aspect of a situation, causing us to misjudge its overall utility. For most investors, the thing they focus on is the daily stock price. Their entire analysis begins and ends with that number. Is it going up or down? This illusion prevents them from seeing the real business behind the stock. Buffett deliberately forces himself to ignore the stock price and focus instead on the underlying cash flow. He changes the lens, and in doing so changes the entire picture. The second bias is anchoring. Our minds are lazy. We grab onto the first piece of information we're given and use it as an anchor for all subsequent judgments. In investing, the current stock price, or a recent 52-week high, acts as a powerful anchor. People think, the stock was at $200, now it's at $120, it must be cheap. Or, it's at an all-time high of $300, it must be a great company. They are anchoring their idea of value to a recent and often arbitrary price. Buffett's method of calculating intrinsic value from the ground up is a powerful way to break this anchor. He creates his own anchor, one based on the economics of the business, not the emotions of the market. This gives him an independent benchmark against which to judge the market's price. So how do we create our own rational anchor? We can use a simplified mental model, a back-of-the-envelope discounted cash flow, or DCF analysis. This sounds intimidating, a tool used in complex financial modeling and investment banking. But the concept is simple. It's just a way of figuring out what a future stream of cash is worth today. Step 1. Find the owner earnings. Go to a company's financial statements. Start with net income. Add back depreciation and amortization. These are non-cash expenses. Then look at the past 5 or 10 years of capital expenditures, the money the company spends on property, plant, and equipment, and subtract the average annual amount. This gives you a rough but useful estimate of the cash the business is truly generating. Step 2. Project the future. This is the art, not the science. Based on the company's history, its competitive position, and the industry it's in, estimate a conservative growth rate for those owner earnings over the next 10 years. If the company has grown at 10% for the last decade, maybe you project 7% for the next one to be safe. Step 3. Choose a discount rate. This is simply the rate of return you require to make an investment worthwhile. A good starting point is the interest rate on a long-term government bond, the risk-free rate, plus a few percentage points of risk premium to compensate you for the uncertainties of owning a business. Let's say this comes out to 8%. This rate is what you'll use to discount the future earnings back to what they're worth in today's dollars. A dollar you are promised in 10 years is worth less than a dollar in your hand today. Step 4. Calculate the terminal value. At the end of your 10-year projection, you need to estimate what the business will be worth from year 11 into perpetuity. A simple way is to take the year 10 owner earnings, assume a very low perpetual growth rate, like the rate of inflation, say 2 to 3%, and use a standard formula to find its value. Step 5. Sum it all up. You take each of the 10 years of projected owner earnings and the terminal value, discount each of them back to the present using your discount rate, and add them all together. Divide that total number by the number of shares outstanding. That final number is your back-of-the-envelope estimate of the company's intrinsic value per share. The goal is not to be precisely right, but to be approximately right. You want to know if the business is worth $100 a share or $20 a share. This process forces you to think like a business owner, not a stock picker. This rigorous, business-focused approach is the polar opposite of how the 99% approach valuation. They fall for two traps: relative valuation and story stocks. Relative valuation is the practice of valuing a company by comparing it to other similar companies. You'll hear analysts say, Company X trades at 20 times earnings, and Company Y is in the same industry, so it should also trade at 20 times earnings. The fatal flaw here is that the entire peer group might be wildly overvalued. It's like judging the height of a person by comparing them to everyone else in a room full of professional basketball players. You get a completely distorted view of reality. You're comparing one potentially irrational price to another. The other trap is the story stock. This is a company with a fantastic narrative, a charismatic CEO, and a product that promises to change the world. But it has one small problem. It doesn't make any money. Investors get so swept up in the story that they forget to ask about the cash flow. The dot-com bubble was the ultimate showcase for story stocks. Companies with no revenue, let alone profits, were valued at billions of dollars based on metrics like website clicks or eyeballs. When the story changed and the market started demanding actual cash, those valuations evaporated overnight. Valuation by narrative is a path to ruin. Valuation by cash is the path to wealth. The direct financial connection here is the fundamental distinction between an asset and a speculation on your personal balance sheet. When you buy a share of a company for a price that is at or below your calculated intrinsic value, you are purchasing a genuine asset. You have a claim on a future stream of cash flows that justifies the price you paid. It is a productive piece of ownership. However, when you buy a stock for a price significantly above its intrinsic value, driven by a story or relative valuation, you have not bought an asset. You have made a speculation. You are essentially holding a lottery ticket, hoping that someone else, another greater fool, will come along and pay an even higher price for it before the music stops. The financial health of your future depends entirely on which of these two games you are playing. For Berkshire Hathaway, the $25 million they paid for See's Candies was an investment in a true asset. The $2 billion it has produced since is the direct financial consequence of that disciplined capital allocation. This focus on the cash-generating power of an enterprise is the core principle of all sophisticated financial endeavors, from private equity buyouts to intelligent wealth management. It is the process of building wealth on a foundation of economic reality, not on the shifting sands of market sentiment. Knowing how to value a business is a superpower, but it is useless and even dangerous if misapplied. The world is filled with thousands of businesses, each a complex ecosystem of products, competitors, and economic forces. No single human being can possibly understand them all. The third pillar of Buffett's philosophy, and the one that provides the crucial element of safety and certainty to his valuation process, is the concept of the circle of competence. This principle is not about being a genius. It's about having the intellectual honesty to know the perimeter of your own knowledge. It's about understanding that your financial success is not determined by the size of your circle, but by your discipline in staying strictly within it. And the most dramatic demonstration of this discipline came when the entire world thought Warren Buffett had lost his mind. The late 1990s were a time of wild euphoria. The internet was changing everything, and the stock market was in the grips of the dot-com bubble. A new paradigm had supposedly emerged. Old metrics like earnings and cash flow were dismissed as relics of a bygone era. All that mattered was growth, disruption, and being part of the new digital economy. Technology stocks were soaring to unimaginable heights. Companies that had never earned a dime were worth more than established industrial giants. And throughout this frenzy, Warren Buffett and Berkshire Hathaway did something baffling: nothing. They refused to buy the hot tech stocks. They continued to invest in companies that sold insurance, soft drinks, furniture, and candy. The financial media began to mock him. He was a dinosaur, a relic. A famous cover story in Barron's in 1999 was titled, "What's Wrong, Warren?" The article detailed how his stodgy, old economy approach was being left in the dust by the new titans of tech. He was under immense pressure to change his stripes, to get with the program, to join the party. His response, delivered in his typically folksy and disarmingly simple way, was a masterclass in intellectual discipline. He said, in essence, that he didn't invest in these companies because he didn't understand them. He couldn't, with any degree of certainty, project what a company like Microsoft or Intel would look like in 10 years. Technology changes too fast. A company with a dominant position today could be rendered obsolete by a new invention tomorrow. How could he possibly calculate the discounted value of future cash flows if he had no rational basis for predicting those cash flows? He knew how to analyze the durable competitive advantage of a company like Coca-Cola. People would almost certainly be drinking more Coke in 10 years than they were today, and no startup in a garage was going to displace it. He understood the economics of the insurance business inside and out. But for the tech darlings of the day, he simply said, "It's outside my circle of competence." He admitted his own ignorance. While others were pretending to be experts, Buffett was comfortable saying, "I don't know." Then, in March of 2000, the bubble burst. The Nasdaq index, a proxy for the tech-heavy market, began a brutal, soul-crushing decline. It would ultimately lose over 75% of its value from its peak. Companies that had been worth billions became worthless. Fortunes were wiped out. The new paradigm was revealed to be the same old speculative mania. And through it all, Berkshire Hathaway's portfolio of boring businesses held up remarkably well. Buffett had not predicted the crash. He never claims to be able to time the market. What he did was far more profound. He had a system of operation that protected him from participating in the mania in the first place. His discipline in staying within his circle of competence was the shield that preserved Berkshire's capital while the rest of the world burned. It was a stunning vindication of his commitment to only play games he knew he could win. This commitment is a powerful antidote to two of the most insidious psychological traps in finance: the Dunning-Kruger effect and the overconfidence bias. The Dunning-Kruger effect is a cognitive bias in which people with low ability in a particular domain tend to overestimate their ability. In investing, a little bit of knowledge is an exceptionally dangerous thing. An amateur reads a few articles about artificial intelligence or gene editing, and suddenly feels they are qualified to pick the winning stocks in those incredibly complex fields. They don't know enough to even know what they don't know. Compounding this is the overconfidence bias, our natural tendency to be more confident in our own judgments and predictive abilities than we should be. We all think we are above-average drivers, and we all think we can pick above-average stocks. The circle of competence is a deliberate, systematic framework for fighting back against these powerful internal forces. It is the humility to acknowledge that your brain is just as prone to these errors as anyone else's, and therefore you need a rigid rule to protect you from yourself. It's the simple yet profound admission that knowing what you don't know is the beginning of wisdom. So how can you define the perimeter of your own circle? It's not about your IQ, it's about what you have a deep, practical understanding of. We can use a 3-filter test to help draw the lines. Filter number 1 is the explain it to a child filter. Take a business you are considering investing in. Could you right now explain to an intelligent 12-year-old exactly how this company makes money? What is its product or service? Who are its customers? Who are its biggest competitors? What is its unique advantage that allows it to charge a premium or protect its market share? If you find yourself using jargon or vague platitudes, or if you can't articulate the business model simply, it's a giant red flag. It is outside your circle. Filter number 2 is the 10-year test filter. Ask yourself, do I have a high degree of confidence in what this company and its industry will look like 10 years from now? For a company that makes breakfast cereal or razor blades, the answer is likely yes. The fundamental demand is unlikely to change dramatically. For a company on the cutting edge of social media or biotechnology, the honest answer is almost certainly no. The competitive landscape is simply too dynamic and unpredictable. If you can't confidently envision the business in a decade, you can't confidently value it today. Filter number 3 is the scuttlebutt filter. Do you know the industry well enough to ask intelligent, non-obvious questions? If you were able to speak with customers, suppliers, or former employees of the company, would you know what to ask them beyond the basics? Do you understand the key performance indicators for that industry? Could you perform your own fundamental analysis and sanity check the claims made by management? If your entire knowledge base comes from reading news headlines and analyst reports, you don't have an informational edge. You are just part of the crowd. If a potential investment cannot pass through all 3 of these filters, you must have the discipline to pass. No matter how exciting the story, no matter how much the stock is going up, you must let it go. This disciplined approach stands in stark contrast to the path of the 99%, the path of the fear of missing out, FOMO, investor. The FOMO investor has no circle of competence. Their portfolio is not a curated collection of well-understood businesses, but a chaotic grab bag of the latest trends and hottest tips. In the late 90s, they bought dot-com stocks. In the mid-2000s, they were flipping houses. In recent years, they have chased cryptocurrencies, meme stocks, and speculative tech. Their core investment thesis is simply, it's going up and I don't want to be left behind. They have no deep knowledge of any of these assets. They are constantly jumping from one narrative to the next, perpetually late to the party, and often left holding the bag when the narrative changes. They mistake being active for being smart. Their constant buying and selling feels productive, but it is the financial equivalent of running on a treadmill, a lot of motion, a lot of sweat, but ultimately going nowhere. This approach is not just financially inefficient, it is psychologically exhausting, a roller coaster of greed and fear driven by the headlines of the day. The direct financial connection of staying within your circle of competence is all about risk management and the reduction of portfolio volatility. When you invest in a business you do not understand, you cannot accurately assess the risks. You don't know what you don't know. You are blind to the competitive threats, the technological shifts, or the regulatory changes that could permanently impair the business's earning power. Your portfolio is therefore exposed to massive, unknown risks. By staying within his circle, Buffett ensures that he can, for the most part, identify and evaluate the key risks to his investments. He may not be able to predict the future, but he has a much clearer understanding of the range of possible outcomes. This is why, during the dot-com bust, Berkshire Hathaway's book value continued to grow while the broader market was imploding. It wasn't because he was a stock market wizard. It was because he was a disciplined business analyst who refused to play in games where he didn't understand the rules. This commitment to intellectual honesty is the bedrock of professional asset management. It is the realization that long-term financial freedom is not achieved by hitting home runs in fields you don't understand, but by consistently hitting singles and doubles in the one small part of the ballpark where you have a genuine sustainable edge. You now have the first 3 pillars: you have learned to see Mr. Market as your servant, not your guide. You have a framework for calculating the rational intrinsic value of a business, and you have the discipline to only operate within your circle of competence where your calculations have meaning. But there is one final, crucial step that bridges the gap between analysis and action. It is the principle that provides the ultimate defense against the uncertainties of the future, the errors in your own judgment, and the vicissitudes of fortune. This is the fourth pillar, the margin of safety, popularized by Benjamin Graham in his seminal work, Security Analysis. The margin of safety is the simple yet profound idea that you should never just buy a business at what you think it's worth. You must demand a significant discount. It is the engineering equivalent of building a bridge that can hold 30,000 pounds, but only ever driving 10,000-pound trucks across it. That buffer is the margin of safety, and the story that perfectly encapsulates its power is Buffett's investment in the Washington Post Company. The year was 1973. The American stock market was in the midst of a brutal bear market. The economy was struggling with stagflation. The mood was bleak. On top of this, the Washington Post newspaper was at the center of a political firestorm. Its reporters, Bob Woodward and Carl Bernstein, were aggressively pursuing the Watergate scandal, which would ultimately lead to the resignation of President Richard Nixon. The Nixon administration was openly hostile to the company and its powerful publisher Katharine Graham, threatening its television broadcast licenses. The company was shrouded in a cloud of political and economic uncertainty. Mr. Market, in his characteristic fashion, was terrified. He punished the stock mercilessly. The price was driven down so far that the market capitalization of the entire Washington Post Company, which included the flagship newspaper, Newsweek magazine, and several highly profitable network-affiliated television stations, sank to a mere $80 million. Buffett, from his perch in Omaha, looked past the scary headlines and the political drama. He began a deep, methodical security analysis of the company's assets, just as his mentor Graham would have done. He started by valuing the television stations. These were wonderful businesses, local monopolies that gushed cash. He conservatively estimated that the TV stations alone, if sold off, were worth at least $100 million. He then looked at Newsweek magazine and the newspaper itself. These were also valuable assets with strong brand names. In his mind, the total intrinsic value of all the component parts of the Washington Post Company was somewhere between $400 and $500 million. And yet, Mr. Market, in a fit of pique and fear, was offering to sell him the entire enterprise for just $80 million. This was not just a discount. This was a canyon-sized margin of safety. He was being offered the chance to buy a $400 million business for $80 million. Put another way, he could buy the company's television stations and get the Washington Post newspaper and Newsweek magazine thrown in for free, with $20 million in cash to boot. It was an absurdity of epic proportions. Buffett began buying shares aggressively. He invested over $10 million, acquiring a large stake in the company. He understood that he didn't need to be perfect in his analysis. The future was still uncertain. Maybe the TV stations were only worth $80 million. Maybe the newspaper would face more political pressure. It didn't matter. The discount to a conservative estimate of value was so enormous that it provided a cushion against almost any conceivable negative outcome. The purchase price itself was his protection. And what happened? The Watergate scandal solidified the Washington Post's reputation as one of the world's premier journalistic institutions. The political threats faded. The company's businesses continued to churn out cash. The market eventually woke up to the reality of the value it had ignored. That $10 million investment would eventually become worth over $1 billion, a 100-fold return. This legendary success was not born from a brilliant prediction of future events. It was born from the simple, disciplined act of demanding and then seizing a massive margin of safety. This principle is a direct psychological antidote to one of the most powerful biases hardwired into our brains: loss aversion. The concept, developed by Nobel laureates Daniel Kahneman and Amos Tversky, demonstrates that for human beings, the psychological pain of a loss is roughly twice as powerful as the pleasure of an equivalent gain. Losing $100 hurts twice as much as finding $100 feels good. This is why investors panic during market downturns. The pain of seeing their portfolio value decrease triggers a powerful, primal fear response that compels them to sell, often at the worst possible moment, just to make the pain stop. The margin of safety is a system for reprogramming this response. When you buy a stock at a 50% discount to its intrinsic value, and then the price drops another 20%, your reaction is not pain or fear, it's excitement. You know the underlying value is still there, solid and secure. The business is still worth $100 a share. You bought it at $50, and now Mr. Market is offering you more of it at $40. The drop in price is not a validation of your fears, but an opportunity to increase your future returns. It completely reframes a psychologically painful event into a rationally attractive one. It is the mental armor that protects you from the emotional ravages of loss aversion. So how do we apply this in a systematic way? We can use a two-pillar valuation system to build a margin of safety into every investment decision. Pillar 1. Calculate the intrinsic value. This is the work we discussed in the second chapter. Using your back-of-the-envelope DCF and staying within your circle of competence, you arrive at your best rational estimate of what the business is worth on a per-share basis. Let's say your careful analysis concludes a company is worth $100 per share. This number is your first pillar, your North Star. Pillar 2. Set your margin of safety percentage. This is a crucial executive decision. You must decide, in the cold light of day, before you are caught up in the emotion of a falling market, what discount you require to pull the trigger. For a very stable, predictable business, like a utility or a consumer staple, you might require a 25% margin of safety. For a more cyclical business, like an automaker or a bank, where the future is less certain, you might demand a 50% margin. This percentage is your personal rule. It is non-negotiable. Step 3. Calculate your buy price. This is simple math. If your intrinsic value is $100 and your required margin of safety is 50%, your buy price is $50. You do not even consider purchasing the stock at $51. Your decision is made. Step 4. Be patient and wait. The market will not offer you these kinds of bargains every day or even every year. Your job is not to chase stocks. Your job is to have your shopping list of wonderful businesses, know their intrinsic value, know your buy price, and then wait patiently for Mr. Market to have one of his periodic episodes of extreme pessimism. When he offers you that wonderful business at a silly price, you act decisively. This disciplined patience is the absolute antithesis of how the 99% operate. They are masters of paying for growth and buying at the top. Instead of demanding a margin of safety, they are often willing to pay a premium. During a bull market, they will look at a fast-growing company and justify paying a price that is 100 times its annual sales or has no earnings at all. They do this by extrapolating its recent spectacular growth rates far into the future, assuming a perfect rosy scenario with no bumps in the road. They are paying a price that not only reflects the current reality of the business, but also a decade of flawless execution and uninterrupted growth. There is no buffer for error. There is a negative margin of safety. The price is pregnant with optimism. When that company inevitably hits a rough patch, a new competitor emerges, growth slows, a product launch fails, the stock price collapses. It has to. There was no cushion of value in the purchase price to absorb the bad news. The people who buy at the top are guaranteeing that any deviation from perfection will result in a catastrophic loss of capital. The direct financial connection of the margin of safety is that it is the single greatest determinant of your long-term investment returns. It is simple, unavoidable mathematics. If you buy a $100 asset for $50, you have a guaranteed 100% return just from the price reverting to its fair value. If you buy that same $100 asset for $95, your return from the price reverting to value is a paltry 5.2%. The price you pay at the beginning dictates the outcome at the end. Every dollar you shave off your purchase price is a dollar of risk removed and a dollar of future return added. This is not a concept limited to stock investing. It is the fundamental principle used by the world's most sophisticated capital allocators. When a private equity firm considers buying an entire company, they are not just trying to buy it for what it's worth. They are fighting to buy it for a significant discount to what it's worth. This institutionalizes a defense against the fact that all financial modeling and future projections are inherently flawed. The margin of safety is the admission of fallibility. It is the humble acknowledgement that you will be wrong, and it is the structural mechanism that ensures your errors will not be fatal to your financial health. We have now assembled a powerful toolkit. We understand Mr. Market, we can calculate intrinsic value, we know the importance of our circle of competence, and we demand a margin of safety. But there is a fifth and final pillar, a principle that ties all the others together and unleashes their true power over time. It is perhaps the most difficult principle to master because it requires not intellectual brilliance but emotional fortitude. It is the mandate of patience and strategic inactivity. Once you have done all the hard work of identifying a wonderful business, valuing it and buying it at a significant discount, the hardest work of all begins: doing nothing. This is about letting the magic of compounding work its wonders and exploiting the time arbitrage that the rest of the market, with its frantic short-term focus, willingly gives you. And there is no better testament to this power than Buffett's longest and most famous love affair with a public company, his investment in the Coca-Cola Company. In the aftermath of the stock market crash of 1987, fear was rampant. Investors who had been euphoric just months earlier were now convinced the sky was falling. But for Buffett, the crash was an opportunity. He saw Mr. Market offering wonderful businesses at prices that were, if not ridiculously cheap, at least fair. One company caught his eye in particular. Coca-Cola was, and is, one of the most dominant consumer brands in human history. It had a simple, unchanging product. It had a global distribution network that was virtually impossible to replicate. It had a place in the minds of billions of people. It was a business he could understand perfectly. It was squarely within his circle of competence. He did the work. He studied its financials, its growth prospects, and its management. He saw a company that could continue to grow its earnings steadily for decades to come, with very little need for additional capital. It was a royalty on the thirst of the world. Starting in 1988, he began to buy, and he bought with conviction. Over a period of several months, Berkshire Hathaway invested over $1 billion to acquire a significant stake in the company. But the genius of this investment was not just in the purchase, it was in what happened next. For the next 10, 20, 30 years, Buffett largely did nothing. He held the stock. He watched as the company expanded relentlessly into new markets, from Eastern Europe after the fall of the Berlin Wall to the burgeoning middle class in Asia. He watched as the company used its immense cash flows to buy back its own shares, increasing Berkshire's ownership percentage without him having to spend another dime. He watched as the dividend checks rolled in, growing larger and larger each year, providing Berkshire with billions in fresh capital to reinvest elsewhere. There were recessions. There were market panics. There were periods where the stock went nowhere for years. There were new competitors and changing consumer tastes. Through it all, he held. He didn't try to trade around his position. He didn't sell when the stock seemed expensive and try to buy it back when it seemed cheap. He had bought a piece of a truly wonderful compounding machine, and he had the wisdom to just get out of the way and let the machine do its work. That initial $1 billion investment is now worth well over $20 billion, not including the tens of billions in dividends received over the years. This monumental creation of wealth was achieved not through frantic activity, but through disciplined, intelligent, and profound patience. This philosophy of inactivity is a conscious rebellion against two deeply ingrained psychological urges: action bias and the illusion of control. Action bias is our innate tendency to favor action over inaction. even when there is no evidence that action will lead to a better outcome. In the face of uncertainty, we feel a powerful compulsion to do something. For an investor, this means constantly tinkering with their portfolio, selling one stock to buy another, always searching for the next big thing. It feels productive, but it is often counterproductive. Compounding this is the illusion of control, our tendency to overestimate our ability to influence events that are, in reality, outside of our control. We believe we can predict the short-term movements of the stock market, or that we can identify the perfect time to get in and out of a stock. The financial services industry is built on feeding this illusion. Buffett's approach is a radical rejection of these biases. He recognizes that true control comes not from trying to manage the unmanageable gyrations of the market, but from controlling your own behavior. He understands that for a long-term owner of a great business, activity is often the enemy of returns. To combat these biases, Buffett has offered a powerful mental model, the 20-slot punch card rule. He says to imagine that at the beginning of your investment life you are given a punch card with only 20 slots in it. You are allowed to make only 20 investments in your entire lifetime. Each time you buy a stock, you have to punch one of those precious slots. This mental frame changes everything. It immediately forces you to raise your standards. You would never waste a punch on a speculative half-baked idea. You would treat each decision with the gravity it deserves. You would do exhaustive research. You would demand a huge margin of safety. And once you punched the card, you would be far less likely to sell it on a whim, because you can never get that punch back. We can turn this into a practical blueprint. Step 1. Create your watch list of wonders. Spend your time identifying a list of 15 to 20 truly exceptional businesses that pass your circle of competence test. These are the only companies you would ever consider owning. Step 2. Value them and know your price. Do the hard work from the previous chapters. Calculate the intrinsic value for each and determine your margin of safety buy price. This becomes your shopping list. Step 3. Wait with patience. Now you monitor these companies. You read their annual reports. You follow their progress. But you do not act. You wait for months or even years until Mr. Market offers one of these magnificent businesses to you at your predetermined, deeply discounted price. Step 4. When you buy, intend to hold forever. Punch your imaginary card. This act fundamentally shifts your psychological mindset from that of a stock renter who is just looking for a short-term pop to that of a business owner who is in it for the long haul. This framework enforces the discipline and patience required for long-term success. This patient, ownership-based approach is the diametric opposite of the path of the 99%, the path of the day trader and the market timer. The hyperactive investor is addicted to the thrill of the game. They are not analyzing businesses. They are looking for setups and plays. They use complex charts with dozens of indicators, believing they can decipher patterns in the random noise of the market to predict its next move. They are constantly jumping in and out of positions, convinced they can outsmart the collective wisdom of millions of other market participants on a minute-by-minute basis. They churn their portfolio, racking up enormous costs and commissions and, more importantly, taxes. The evidence against this approach is overwhelming. Study after study has shown that the vast majority of active retail traders lose money over time. It is a high-stress, high-cost, and low-return strategy that mistakes the frantic energy of activity for the quiet progress of accumulation. The direct financial connection here is the inescapable iron law of compounding and taxes. Albert Einstein supposedly called compound interest the eighth wonder of the world. It is the engine that turns modest savings into fortunes. But it has one critical requirement: an long, uninterrupted runway of time. Every time you sell a winning stock, you do two destructive things. First, you interrupt the compounding process. Second, and more damagingly, you invite the tax man to the party. You have to pay capital gains taxes on your profit, which immediately reduces the amount of capital you have working for you in the future. Let's run a simple example. An investment of $10,000 that compounds at 10% per year for 30 years becomes $174,000. But if you trade it every year, realize a 10% gain, pay a 20% capital gains tax and reinvest the rest, your final sum is only $99,000. The cost of hyperactivity is almost half of your potential wealth. It's a leak in your financial boat that, over time, will surely sink it. Buffett's buy-and-hold strategy for wonderful businesses is not just a preference. It is a mathematically optimal strategy for maximizing long-term, after-tax returns. This is the core difference between a professional approach to wealth management and amateur speculation. The goal is not merely to make money. The goal is to keep the money you make and allow it to grow on a tax-deferred basis for as long as humanly possible. This is how true, lasting financial freedom is built, not through a flurry of brilliant moves, but through the quiet, stubborn, and unwavering patience to let a good decision compound for a lifetime. You have made it to the end of this deep exploration, and in doing so you have fundamentally altered the way you are equipped to navigate the world of finance. You now possess the foundational operating system of the world's greatest investor, the crucial understanding that price and value are two completely different things. You have learned to see the market not as a source of truth, but as a source of opportunity, personified by the erratic Mr. Market. You have the tools to build your own rational estimate of a company's intrinsic value, a bedrock of certainty in a sea of noise. You understand that your power comes not from knowing everything, but from having the discipline to stay within your circle of competence. You know how to protect yourself from error and bad luck by demanding a margin of safety. And you grasp the immense, wealth-creating power of patience, allowing the magic of compounding to work for you. This is more than just a set of investing tips. It is a complete mental framework for making rational decisions under uncertainty. But understanding the difference between price and value is like knowing how to identify the perfect, strongest steel for building a skyscraper. It's an absolutely essential, non-negotiable first step. Without it, the entire structure is doomed. But it is not the whole blueprint. Warren Buffett's genius isn't just in one model, but in how a network of mental models interlock, support, and amplify one another. Knowing what to buy is one thing, but there are other pieces to his system that govern the equally critical questions of when to buy, how much to buy, and when, if ever, to sell. The framework you have just mastered is the what. It allows you to identify a quality asset at an attractive price. The video that is now appearing on your screen is the next part of that blueprint. It is the crucial link that connects this knowledge of value to the real-world execution of a portfolio strategy. It explores the psychological temperament required to act when others are fearful and the capital allocation models Buffett uses to decide how to weigh his bets. It is the piece of the map that connects the analysis of a business to the management of a fund. You have just mastered the science of valuation. The next step is to master the art of behavior. You have taken the first and most important step from being a speculator, a gambler tossed about by the whims of the market, to becoming a true business analyst, an owner who thinks for themselves. The question now is, are you ready to continue that evolution? The speculator clicks away, looking for the next hot tip. The analyst, the serious student, continues to build their mental arsenal. The disciplined mind continues the journey. The next piece of the puzzle awaits. Click and complete your education.